Asset increase, debit. Asset decrease, credit. So cash decrease, credit. So we will writing down the cash as credit. So land, building to cash. Right? So why we applied pro rata basis or sales or relative sales value? Because we want to know that how much from this 2.8 million belongs to land and how much belongs to the building, right? So this is the accounting treatment for combine or basket purchase. So we have illustration here. So for those who are watching the video, please pause the video, try to solve by yourself, and then find out the answer here. So those who are with us right now, so I'm just showing you the value here. So we know that the total value is 150,000. So that is according to relative sales method. 40,000 divided by 150,000, answer is 26.5. 95,000 divided by 150,000, answer is 63.3%. And 15,000 divided by 150,000 is 10%. So how much you pay? You pay 120,000. So 120,000 according to the values, you multiply those, and answer would be here. And at the end, you make the entries. That's it. Now, let's talk about the expenditures. So anything that is going out from the business categorized as expenditure or expense, right? For example, we pay salaries, cash is going out from the business, that is an expense, right? We are purchasing raw material, cash is going outside the business, that is an expense. So when we use the word capital, it means capital expense or capital expenditure. In some books, they categorize expenditure and expense. Expenditure means whose usage value is for more than 1 year. So the correct name is, or the name is capital expenditure. So whenever we use the word capital, it means its usage or its life is for more than 1 year, right? And expense, immediate expense or expense whose life is less than 1. So you are paying the salaries for 1 month. 1 month time period is less than 1 year, right? So that's why we call this expense. We are paying dividend. So dividend is paying for the 1 year performance. So you are paying in 1 year, it means a value up to 1 year. So this is called expense, not capital expenditure. So capital expenditure that we pay and its value is for more than 1 year. For example, you are paying for building, cash is going out from the business, that is capital expenditure. Okay, you are investing in employees for training. So training is going to be used for more than 1 year. Your employees are going to use that training or that software in which you are, purchasing that and training them to improve your productivity for more than 1 year. Otherwise, you won't do that. So that's why we call this capital expenditures. Here we go. So expenditure increases the asset capacity or extend its useful life, right? For example, your company owns, transportation, vehicles for CEOs or managers, or you gave cars to the managers or CEOs. So now 5 years have passed now, car need major overhaul. If we do not change its tires or overhaul its engine, then we need to sell our, vehicles. And if we spend, expenses on changing the tires or overhauling the engine, then that car gonna be used for another 3 years. And you change the car, so that expenses, and then you change the tires, so that expense for changing the tires increases its useful life. So we call that expense as capital because its life has now increased for more than 1 year, like 3 years, vehicle life has increased, right? So we have an example here. So what we call this capital expenditure, major engine overhaul, modification for the body of a new use of truck, Addition to storage capacity of the truck. So normally these have used in cargo services industry, those manufacturing or factory usage employees who are given cars, vehicles, this kind of stuff. But what do we mean by ordinary expenses? So, for example, repair or maintenance, oil change, lubrication, right? Replacement of tires, windshield, or a plant or a paint job. So these are just ordinary expenses, right? So replacement of tires. If your trucks are like here, because this is a cargo services. So if you are it belongs to a heavy industry who transport goods and services, entire cost is just a minor cost. So it means that every year you are changing the tires. So that becomes your expense because useful life of tires are less than 1 year in that case. If the useful life of tires are not less than 1 year, that would be your capital expenditure, right? So you understand now the nature of how we segregate the capital expenditure versus the normal expenses. So it depends on how you use that asset, right? So if that asset, if you install or change something or spend some money on that one and its useful life or its capacity is going to be increased for more than 1 year, we call this a capital expenditure. Now here we go, we are starting a real deal here. So measure and record depreciation on plant assets. So up till now what we have learned that okay, we purchase this asset. What is the cost of that asset? The cost of that asset is included all the legal fees paid, commission paid, property taxes paid, all the taxes paid, and anything that you pay for the installation, testing to make the plant, machinery, or building usable. We call this is the cost. And how we are going to record the entry? Simple, building to cash or building to payable if we didn't pay cash, or land to cash, just like that, right? And now what happened? You purchased it and now you are using that. You are using the building. The wear and tear happens, yes. The building value loses over time, yes, because we are using that one. So even though the building is not seriously damaged, even then if you are selling that building, the market will say that since you use for 1 year, its value decreases. Even the building is very nice. Even then, there is a cut in the cost, in the value of the building, and we call that depreciation. So depreciation is the process that allocates a plant cost to expense over its life. So like I told you, everything that goes out from the business either is expense or either capital expense. So you paid, for example, $3 million, cash is going out from the business, and for 10-year building. So it means this is a capital expense, but it's going to be divided into 10 years. Each year, capital expense will become expense and will go to the income statement on some kind of rate or some kind of like some basis. So that's why we call this a process that allocates plant assets cost to expense over its life. Its life is for 10 years, so you divide it by 10, answer would be 300,000 is going to be every year. You transferring from the capital expenditure to expense only 300,000 rather than 3 million at once. So it allocates cost against the revenue. The assets help earn each period. It means every year this 300,000 will go to the income statement and it will be less from sales. What is the formula for income statement? Sale minus all cost is your net income. So this is going to be added into the cost. Depreciation expense is reported on the income statement, but remember not the accumulated depreciation. Accumulated depreciation is contra account or opposite account for plant assets. It is written on balance sheet, not an income statement. Depreciation expense is going to be written on income statement. And remember, land value is not depreciated. Land value always appreciated, right? Depreciation means that value is going down. Appreciation means value is going up every year, right? So remember, depreciation is not a valuation process. So some, the thing
Sorry,
that, yeah,
sorry, I have a question. Why is the land value never depreciated?
it's basically economic question, because land supply is always limited, fixed, right? So you cannot produce land according to the need. Your demand of land cannot increase or decrease, right? Supply is fixed and demand can be increased or decreased, but supply is fixed. When supply is fixed, so it means normally the value goes up. Coco, understand?
I understand that there is a limited offer of land, but what about the price value, like according to the market? Like we don't take that into account?
Yes, because when you purchase the land and according to some periods of time, yes, there is a setback, sometimes value decreases, but according to history and the rules of economics, the value of the land doesn't go down deeply, and if it goes down deeply it will recover after some time. For example, in the financial crisis of 2008, so that is the housing market collapsed, and due to housing market the value of the property decreases and value of the land decreases a bit, and after that it recovered again, but the value of building goes down. So
Okay.
in economics, in finance and all the stuff, the value of the land does not depreciate, it's appreciate. So you can also double check from your parents as well. Okay, if your parents bought some kind of property, so you know that that land property they purchased it, for example, for $10,000, now it has $15,000 value is $20,000. Or if you can reevaluate your own house, land, not the building, land, the value would be higher, right? Because population has increased over time and they need to build houses. Demand for houses increases, so houses cannot be built on trees and all the, they have to build on land. So there's a constant demand, that demand has increasing every day, every year due to increasing population. So that's why the value of the land, because of limited supply, always increasing. We call this concept inflation hedged in finance. Let me write it down. Inflation hedged, like value of the